Students, welcome you all once again. And today we are going to talk about Ind AS 2 inventories. So friends, this inventory standard is a small standard, but very important standard, right? And just to give you a comfort, in our accounting standard, we have read AS2, accounting standard 2, right? In Ind AS, the number is same. It is Ind AS 2. So why in Ind AS the number is Ind AS 2? Because globally it is International Accounting Standard 2, right? And Ind AS are the Indianized version of IFRS. So from IAS 2, we have maintained Ind AS 2, right? So this inventory standard is AS2 in accounting standard, Ind AS 2 in Indian accounting standard, and in IFRS it is IAS 2. If I talk about all these three standards, there is no much difference between these three standards, except in this standard some detailed guidance is available. Otherwise, there is no difference between AS2, Ind AS2 and IAS2. Majorly, this Ind AS2 is similar to AS2, right? Okay. So to start, objective and scope of the standard. What is the objective of this standard? As the title suggests, the objective is to prescribe the accounting treatment of inventories. Accounting treatment of inventories. And friends, whenever someone says that accounting treatment, what is meant by accounting treatment? Accounting includes, please write down, accounting includes RMPD. Accounting includes RMPD. What is meant by RMPD? RMPD means recognition, measurement, disclosure. RMPD means recognition, measurement, presentation, disclosure. Okay. RMPD means recognition, measurement, presentation, disclosure, which means that this standard provides the recognition principle, measurement principle, right? Presentation principle and disclosure principle in relation to inventory. I hope it is clear to all of you. Yeah. Accounting treatment does not mean only accounting entries. Sometimes students think that when faculty or when a teacher is talking about the accounting treatment, so the first thing which comes in their mind is accounting entries. It is not only accounting entries. In addition to accounting entries, it is, how it is going to be measured, how it is going to be presented, how it is going to be disclosed, right? So these all four aspects is covered under accounting treatment. Okay. So this standard provides the recognition principle, measurement principle, presentation, and disclosure in relation to inventories. Okay, now coming to the scope part. If I talk about scope, this standard is applicable to all inventories, right? What could be the inventories? For Maruti Suzuki India Limited, what is inventory? Maruti cars are inventories, right? For Tata Motors, what is inventory? For Tata Motors, again, cars are inventory like Tata Nexon, okay, Tata Punch. For Boeing or Airbus, what is the inventory? Aircrafts are the inventory for, Boeing or Airbus, right? Yeah. So friends, for Nestle, what is the inventory? For Nestle, like they are into cold drink, they are into chips. So what is inventory? Maggie, right? So these are the inventories. So this standard is applicable to all inventories in which the business is trading, okay, in which the business is manufacturing, except, so some negative list is given, except work in progress arising under a construction contract, including directly related services, right? So let's say if the company is into construction of roads, right? So the work in progress, which is under construction contract and which includes directly related services, that has to be measured under Ind AS 115, not under Ind AS 2. Second, financial instruments, right? So few class later, you will understand the financial instruments. So these financial assets, financial liability is outside the scope of Ind AS 2. Okay, this is outside the scope of Ind AS 2. Biological asset. For example, if a company is dealing or trading into shares. So what is shares? Shares are the financial instruments. So this is outside the scope of Ind AS 2. Biological assets related to agricultural activity and agriculture produce at the point of harvest. So friends, Ind AS 41 deals with biological asset. For example, if the company is dealing in cows, buffaloes, right? These plant and animals. So these are the biological asset, and these biological assets are outside the scope of Ind AS 2, right? Because these biological assets are measured and accounted for in accordance with Ind AS 41. Measurement of inventories held by producer of agricultural produce after harvest and commodity broker traders measuring inventories at fair value less cost to sale. Right. So if there are producer of agriculture produce, what is meant by producer of agriculture produce? For example, let's say Nestle is there or ITC is there. Let's say they have their own mango orchards, right? They have their own mango orchards. Okay. So mango tree is a tree. It is an asset. And what is mangoes? Mangoes are the agriculture produce. Okay. So ITC, if they are having their own mango garden or mango orchards, so they are getting the mangoes, which are the agriculture produce, right? So ITC is known as the producer of agriculture produce, right? So when they are plucking mangoes, okay, so they are getting the mango free of cost. So at what value these mangoes are going to be recognized in inventory? So this measurement is provided by Ind AS 41, not by Ind AS 2. Understood? So why the word producer of agriculture produce is used? For example, if you are ITC and you are buying mangoes as a raw material for making cold drinks, for making chocolates, toffees, right? You are buying mangoes from outside. So then this mango is a raw material. Then it is coming under Ind AS 2 inventory, right? But if you are the producer of mangoes and you are using those mangoes in your production, right, for the finished goods, in that case, the measurement of this agriculture produce, the measurement of these mangoes are not covered by Ind AS 2. It is covered by Ind AS 41. When you read Ind AS 41, you will be able to understand this aspect. But just to begin with, or just to understand that this standard is applicable to all inventories except there are four exceptions. One, work in progress relating to the construction projects. So this is covered under Ind AS 115. Financial instruments are covered under Ind AS 32 and 109. Biological assets are covered under Ind AS 41. And measurement, this talks about measurement and measurement of inventories, which is held by producer of agriculture produce, is also outside the scope of Ind AS 2. Right? Let's move on. Now coming to the main part of inventory, that what is inventory? What is meant by inventory? Okay. A lot of students have joined. So good morning, Shailesh, Mansa, Naveen, Viraj, Vimal, Tanisha. Good morning, everyone. Hope all are doing well. Inventory, again, what is inventory? Inventory is an asset, right? And which kind of asset? What is inventory? Inventories are asset, but which kind of asset? Inventories are assets. Can you tell me what are the classification of inventory? What kind of inventories are there? I'm sure with the knowledge of accounting standard 2 and with your articleship knowledge, you can give me this answer. You're right, Rahul. So inventories are finished goods, work in progress, raw material. You're right. Inventories are inventories are assets. Number one, held for sale in ordinary course of business. Held for sale. Something which is held for sale is kind of a finished goods for that entity. Finished goods. So that is known as a finished goods. Okay. So the first part talks about the finished goods. Okay. So inventories are assets which are held for sale in the ordinary course of business. Let me take an example here, and you need to tell me whether this is known as an inventory. Tata Consultancy Services, TCS. Okay. TCS bought 5 cars for their top executives, for their top management. Okay. TCS ने 5 कार खरीदी. TCS bought 5 cars, 5 Maruti cars for their top executives, for their top employees. These employees didn't like the car, and now TCS is selling these cars. TCS, you all heard about Tata Consultancy Services. Tata Consultancy Services is a information technology company, IT company. It's a big IT giant. So TCS bought the cars for their top class employees, but those employees didn't like that car, and now TCS wants to sell these cars. Whether these cars are inventory for TCS, tell me. If your answer is no, then you need to tell me the reason why no. Because TCS is selling these cars. TCS wants to sell this car and TCS have to sell this car. So why no? What is the rationale behind no? Yeah, why no? Yes, very good, Ritvik. So this is not an inventory for TCS. Why? Because this is not in the ordinary course of business. The job of TCS, the business model of TCS is not to sell these cars. Eventually, they are selling this PPE, property, plant and equipment. This is PPE, right? This is PPE. This is not a inventory. This is not an inventory because TCS is not dealing in selling of these cars. Instead of TCS, had it been a TCS, instead of TCS, had it been a Tata Motors or Maruti, in that case, whether the sale of car for Maruti Suzuki India Limited and Tata Motors, is it an inventory? Yes, it is an inventory. Yes, it is an inventory. Why? Because the bread and butter, the business model of Maruti Suzuki India Limited and Tata Motors Limited is to sell the car in the ordinary course of business. They are manufacturing and they are selling cars. Okay? They are manufacturing and they are selling cars. This is in the ordinary course of business. Right? Very good. So, friends, inventories are finished goods which are held for sale in the ordinary course of business. In the process of production of such sale, in the process of production for such sale. Okay. For example, Tata Motors. Tata Motors is selling the car. The car which you are, the car which are there in their showrooms, which you are looking at, which you are buying. So this is the final product. This is the finished goods. But for getting this finished goods, there is a lot of efforts behind, right? There are some material involved. For example, the seats, the foam is there, the plastic is there, the rubber is there, right? Engine is there, the steel is there, iron is there, right? The batteries are there. So glass are there. Okay. So a lot of raw material is there. And when these raw materials are getting assembled, then it take a shape and form of a car, right? So in the process of production for such sale, on 31st March, whatever efforts Tata Motors has taken, whatever raw material is there, so everything has not been converted into car. They are in the production of completion, which is known as work in progress. So work in progress. So inventories are assets which are also in the process of production of such sale. Means work in progress. Okay. So this is number 2. Number 3, in the form of material or supplies to be consumed in the production process or in the rendering of services. For any automobile companies, they have the raw material in terms of plastic, in terms of steel, in terms of iron ore, in terms of batteries, in terms of glass, right? So a lot of in terms of paint, okay, in terms of form, so in terms of wires, okay, so a lot of raw materials are there. So this also includes raw material as well, RM as well, okay. So friends, inventories are assets which are finished goods, work in progress, and raw material, right? Same thing which we have learned in our accounting standard 2. Simple. Sir, in addition to finished goods, work in progress, raw material, is there anything else which can be classified as an inventory? Yes, it could be your spare parts. It could be your loose tools. It could be your jigs and dies, right? Spare parts, loose tools, jigs and dies, this can also be classified as inventory, provided it should not meet the definition of PPE. Right, friends? You all are comfortable? I move ahead. Very good. Very good. Rohini is asking, sir, whether raw material is also measured and accounted for in accordance to Ind AS 2. Yes, Rohini. So raw material, work in progress, and finished goods. This is inventory and it has to be accounted for as per Ind AS 2. Now, few pointers about inventory, few important points. Inventory may include assets that are being produced for resale. For example, software. So inventory, Infosys, Wipro, TCS, the Birla Soft, the job of these companies, the business model of these companies is to sell softwares, is to provide IT services. Okay. So if the company is buying some software for selling, so of course it is an inventory. So inventory may include intangible assets, right, that are being produced for resale. Okay. Like software. Tally software. The Tally is selling the licenses of Tally software. So that is an inventory for this company. Okay. Inventory also includes properties that have been purchased or are being developed for resale in the ordinary course of business. Godrej Properties, DLF, M3M. Have you heard about these companies? Hiranandani, Godrej Properties, DLF, Hiranandani, okay, M3M. You must have heard about these companies. So what is the business of these companies? The business of these companies is to buy land and sell the plots of land. The buy properties and sell properties, develop properties and sold them to the buyers. So these properties are also inventory for these companies. Which companies? These properties are inventory if it is held for resale in the ordinary course of business. I am Alok Garg. I have bought one property, okay, for the purpose of selling, or let's say I have bought one property and I got a good price and now I want to sell that property. Is that property inventory for me? Answer is no. Because my business is not to sell these properties in the ordinary course of business. Is that clear? So my business is not to sell this property in the ordinary course of business. So this is known as, so this is not an inventory for me, but for DLF, these properties are inventory. These properties are not fixed assets, not PP, right? Okay, very good. MR, yes, MR group into sale and purchase of properties, into construction of properties. Spare parts, standby and servicing equipment, for example, tools and consumable lubricants, are classified as inventory unless they are expected to be used for more than one period or can be used only in connection with an item of PP, in which case they are classified as PP. For example, during your articleship period, probably if you got a chance to visit some factories, right, or some production houses, you must have seen there are big plants, there are big factories, right? And on a regular basis, these machineries requires some lubrication, so some greasing, right? So these lubricants, grease, small tools, which is regularly required for these machineries are classified as an inventory. And there are few major spare parts also, right? Few spare parts which is also required for these machineries, but the life is much more for those spare parts. For example, after every 10,000 hours, a particular machinery needs a replacement of a major spare part, right? And normally this 10,000 hours, this machinery will take, around 2 years to cover the 10,000 hours. So it means after every 2 years, this spare part needs to be replaced. So if the company has purchased that spare part, which is there in their warehouse, so that spare part is not an inventory. Why? Because the life of that spare part is more than 1 year, right? More than one period. So that spare part is classified as a PPE. But if it is a spare part, standby equipment, servicing equipment, right, which is required on a regular course of business, which is required regularly, let's say at a frequency of a quarter, 3 months, 4 months, 2 months, every week. So then it is classified as an inventory, right? Yes. Reusable and returnable packaging or parts, right? I'm sure that you guys have had cold drinks, okay? And you have seen that cold drinks in the carrots. Have you seen that cold drink in the carrots? So let's say this is the carrot, and in the carrot there are a lot of cold drinks which are there in the carrot, right? A lot of cold drinks are there in the carrot. Okay, so a lot of cold drinks are there in the carrot. So friends, this carrot is whether this carrot is an inventory, or when you are buying a soft drink, or buying a cold drink in a glass bottle, and after drinking you are returning that glass bottle to the shopkeeper. So this reusable or returnable packaging or parts, whether it is an inventory, this is not an inventory if it has to be used for more than one period or more than 1 year, right? But let's say you are having slice or maja in the plastic bottle, and that primary packing material, right? If that bottle would not be there, this liquid cannot be stored, right? So that primary packing material, is it an inventory? Yes, it is an inventory. It is not a returnable or packaging material, right? So friends, there are two kind of packaging material. If it is a primary material, it is an inventory. But if it is a secondary packaging material, it is not an inventory, right? It is not an inventory. Maggie. So normally what happens when you buy Maggie? So how did you get the Maggie? So the Maggie is stored in a wrapper, right? एक wrapper होता है ना, एक packet होता है Maggie का, right? And when the Maggies are coming to the shopkeeper, reaching to the shopkeeper from the factories, so these are into a carton. Okay, there is a corrugated box carton. There is a corrugated box in which this packaging of Maggie is stored. So in this case, this carton, right, is considered as a secondary packaging material, and that that wrapper of Maggie is considered as a primary packaging material. So primary packaging material is considered as an inventory, right? But the secondary packaging material is not considered as an inventory. Understood? So friends, coming to this illustration, as per Ind AS 2, inventories includes material and supplies awaiting use in the production process. Whether packing material and publicity material are covered by the term material and supplies awaiting use in the production process. So materials and supplies awaiting use in the production process. So whether packing material and publicity material, right? Whether it is covered by the term material and supplies awaiting use in the production process. So while the primary packing material may be included within the scope of the term material and supplies awaiting use in the production process, but the secondary packing material and publicity material cannot be included. These are covered in the selling cost. Have you bought Amul milk, curd? So this milk and curd, how you got this milk and curd? you are getting this milk and curd packed in a plastic wrapper or a container, right? So this is a primary packing material. This is important to store to transfer these goods and services. But the secondary packing material, for example, this milk, when it is reaching to the warehouse, when it is reaching to the shopkeeper, probably these packets are stored in a big container, okay, in a big box. So that is a secondary material. That is a secondary material. And that secondary material is not considered as an inventory. It is a selling cost. I hope you guys have understood the meaning of primary material, secondary material, secondary packing material. Okay? For this purpose, the primary packing material is one which is necessary to bring an item of inventory to its sellable condition. For example, bottles, cans, etc. In case of food and beverages industry. Other packing material required for transporting and forwarding the material will normally be in the nature of secondary packing material. Okay. So 1,000 packets of Amul, it is not convenient to transfer 1,000 packet of Amul from factory to the shopkeeper. So that is why they have to be stored in a box, right? So just to transfer this from this place to another place, this has been stored in a box. Okay. So hence it is considered as a selling cost. Okay. But the packets in which the milk is stored, that is a primary packaging material, and hence it forms part of the inventory. Is that clear? Is that clear? Pooja is yes, sir. It is similar to Indes. Yes, yes, Pooja. Sir, in case of automobile industry, is there any primary packing? So normally in case of automobile industries, when you buy a car, you must have seen that, there are am I audible now? Okay. Yeah. So in case of automobile industry, when you buy a car, you must have seen that, this car is having some, packaging in terms of the seats, right? The seats are covered into by a plastic, by a polythene. Okay. So this plastic is considered as a primary packing material. Okay. So friends, this plastic is not reusable. This plastic is not returnable. This is kind of a primary packing material so that the seeds are not get dirty. Okay. Or the seeds are not get stained. Right. So that is why this this thing is used for this auto in the automobile industry. Right. But normally these cars are coming from the factory to the showrooms. So in case of transportation, if the manufacturer is using some secondary packaging material, like they are covering this entire car, okay, or they are giving a shield to the car, so that is not a primary packaging material. So normally primary packing material is considered as those material which is critical, which is important to store, number one. Second, it is reaching to the customer directly, and which is not returnable in the which is not returnable generally, right? Is that clear? I hope it is clear now. Good. Let's move on. Measurement of inventory. Now, friends, it is important. Sir, we understood that what is inventory. Now it is important that at which value the inventory is going to be measured. So friends, inventory is going to be measured at the lower of cost and net realizable value, right? At the lower of what? Lower of cost and NRV, net realizable value. And we will understand these two concepts one by one. What is meant by cost and what is meant by net realizable value, right? We'll understand this concept. Okay. First of all, what is meant by cost? There are three parts of the cost. There are three legs of the cost. Number one, cost of purchase. Simple. You are an automobile industry. You are a manufacturer. And for manufacturing a car, you need a lot of raw material. You need a lot of stuff, right? You need plastic. You need wires. You need batteries. You need glass. You need steel. You need iron. A lot of things you need. So you are going into the market and you are purchasing those items. So this is cost of purchase, right? Then cost of conversion. This this raw material will not take a shape of a car until and unless you will put your efforts in terms of labor, in terms of, the other things like in terms of gums, in terms of welding, in terms of electricity. So you need a lot of inputs to assemble this raw material, right? To take it a shape of a car. So cost of conversion. Then the other cost, which is incurred in bringing the inventory to their present location and condition, right? There could be some other cost also, which is important to bring the inventory into their present location and condition. For example, in case of liquor industry, the grapes or the other fruits or some other raw material has to be kept in a storage facility for years, for long years, right? Why? So that this wine will become a good wine. Okay. Friends, so that storage cost is necessary for this kind of industry and this kind of inventory for getting ready for their intended use, right? So what is your cost? Cost includes cost of purchase, cost of conversion, and the other directly attributable cost, which is important to bringing the inventory in the location and condition, right? For example, if you are purchasing a raw material and you are also incurring a transportation cost, whether it will form part of inventory, answer is yes. Otherwise, if you will not bring the inventory into your factory premises, how will you use this inventory? So any cost which is important in bringing the inventory to their present location and condition, right? I am buying a raw material from China. My factory is in New Delhi. So China से Delhi तो लाना पड़ेगा ना raw materials. नहीं तो मैं production कैसे करूंगा? So this freight which I am incurring, this transportation cost which I am incurring, it is form part of your inventory, right? So we'll also discuss these three concepts in detail: cost of purchase, cost of conversion, and other cost. Coming to the cost of purchase means your purchase cost includes what? Includes purchase price. You are going to a supplier and supplier is selling you the material inventory and he is issuing you an invoice, right? So that in that invoice a purchase price is there. Okay. So when you are buying a goods from China, so of course that price is there, purchase price is there, that is your purchase price, that is your cost. Then you are getting this raw material from China to India. There is a freight cost, there is a carriage inward, there is a transportation cost, there is a handling cost, right? It also forms part of your cost of purchase. Taxes which are not recoverable. For buying these goods, you are also paying a GST. And let's say this GST is not recoverable. This GST is not recoverable. Okay. In that case, it will form part of your cost. Cost means cost of inventory. But if that GST is recoverable in nature, in that case, you will take an input credit of your GST. It is not your cost. So non-recoverable taxes. For example, you are paying an import duty and it is non-recoverable. So it will form part of your cost of inventory. And other costs directly attributable to the purchases. and other costs directly attributable to the purchases. Right? Is that clear? I hope this cost of purchase, it is quite clear to all of you, this cost of purchase. Now there is a guidance in the cost of purchase, there is a guidance deferred payment. For example, if you are buying an inventory and paying upfront, so you are getting that inventory at 100 rupees per kg. Okay. But you don't have money and you are saying to the supplier that I don't have money right now. Can you sell the goods on a credit basis to me? I'll pay you after 1 year. So the supplier is selling goods at 120 rupees. 120 rupees. So friends, the supplier is charging 20 rupees extra, 20 rupees more. Why? Probably due to the deferred payment terms, right? So standard says that when the payment for inventory is deferred beyond normal credit terms, right? Let's say that industry, that supplier is giving a credit of 15 days to everyone. It is a normal trade parlance in that industry. But this buyer is asking for a 1 year credit term. So the supplier is demanding extra payment, right? In that case, that extra is considered as an interest cost. That extra should be considered as a financing cost, interest cost, and it will not form part of your inventory cost, right? Is that clear? Is that clear? And when a payment for inventory deferred beyond normal credit terms, the arrangement contains a finance element and interest should be imputed if the impact is material. Okay. So this deferred payment cost, this interest cost should not form part of your inventory. It has to be recorded as an interest cost, finance cost. Discount and rebate on purchases. You are buying in bulk. You are buying, let's say, 10,000 quantity and you are getting a discount of 5% upfront. In that case, this trade or volume discount and rebates are deducted from the cost of purchases. Right? So this was the guidance about cost of purchases, cost of inventory. Now coming to the cost of conversion. So what is meant by cost of conversion? Friends, the processing of raw material requires a lot of efforts. Okay. So the inventory, the finished goods, the car, the refrigerator which you are looking at, the mobile phone which you are looking at, it is an outcome of three things. What are the three things? It is an outcome of your material, right? It is an outcome of your material. Then it is an outcome of your labor. And then there is it is an outcome of your overhead. Material, labor, and overhead. MLO. Material plus labor plus overhead. Right? So friends, only raw material will not get the inventories. You need some extra material to convert those raw material into the final product. For example, you need some gum, solution, dyes, lot of things, right? Welding machine, lot of things to process that raw material. And for that, you need some human effort as well. You need labor, you need some other overheads as well, right? So this is known as a cost of conversion. So cost of production or conversion include all direct costs like labor, material, and direct overhead, and an allocation of fixed and variable production overhead as well. Right? For example, the factory in which you are producing goods, and every month you are paying a rent of that factory. What is that? The rent is a fixed cost. The rent is a fixed cost. Okay. Let's say you are also paying a rent on the basis of, units produced. You are paying some extra cost on the basis of units produced. That is a variable cost. That is a variable production overhead, right? Friends, this cost of conversion includes the direct cost as well as allocated cost, For example, the depreciation, maintenance of factory building, rent of factory, right? So these are indirect costs. Indirect costs, I mean to say, these has to be allocated to the cost of inventory. These has to be allocated to the cost of inventory, right? But the direct cost like labor, which is involved in that production, the material, the overhead, which is directly related to that production, that is a direct cost. But there are some indirect costs also, depreciation and maintenance of the plant and machinery, your rent of the factory building. These has to be allocated to the cost of production. Okay. So there could be some fixed cost, there could be some variable production overhead. So this is known as a cost of conversion. Okay, this is known as a cost of conversion. Now question arises, sir, variable, there are two overheads, fixed overhead, variable overhead. Variable overhead varies with the unit of production. It is a quite clear. But sir, how to allocate the fixed overhead? It is very important, guys, and this part you need to understand very clearly. This part is important. For example, in the first month, there is a production of 10,000 units. In the second month, the production of, let's say, let me take you, let me take you on the Excel file. I hope this Excel file is visible. Month 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10, 11, 12, right? Production units 8,000, 1,000, 1,000, 3,000, 7,000, 9,000, 6,000, 4,000, 10,000. Again, let's say 5, 8, and 1. For example, variable overhead. Variable overhead. So variable overhead varies per the unit of production. So variable overhead is fixed per unit. Normally, variable overhead is fixed per unit. It is a unit cost. Variable overhead is rupees per unit. It varies in total. It varies in totality. But it is in totality, but it is per unit fixed, not variable. Let's say multiply by 2. Right? This is your variable overhead. Now, there is a fixed overhead. Fixed overhead is fixed in totality. Fixed overhead. Say that is rent. Is rupees 1 lakh. Now the question arises how to allocate this fixed overhead. How to allocate this fixed overhead. Right? Sir, it is very simple. What we will do, whatever is the cost of product, whatever is the unit of production, we will divide this fixed overhead, divide by unit of production. Answer is yes, as well as answer is no. Let me tell you. Please write down fixed overhead has to be allocated on the basis of on the basis of budgeted oblique normal production. Okay. On the basis of budgeted oblique normal production. Okay. Any efficiency directly taken to profit or loss. Profit and loss. Sir, what does it mean? What does this mean? Understand. Let's say fixed overhead, that is rent of factory is rupees 1 lakh. And what is given? It is given that normal production unit is 5,000. Normal production unit is 5,000. The normal or budgeted production unit is 5,000. So friends, if the normal or budgeted production unit is 5,000, what is your per unit cost overhead? In that case, per unit cost of fixed overhead is how much? 1 lakh divided by 1 lakh divided by 5,000, right? It comes out to how much? 20 rupees per unit. 20 rupees per unit. Is that clear? It comes out 20 rupees per unit. Whether my voice is clear? Am I audible? Am I clear and loud? Can you please confirm if I'm clear and loud? Okay. Okay. It's clear now? Okay. Yes. The fixed overhead is 1 lakh rupees. We are discussing how to allocate the fixed production overhead on the per unit of output. Okay. Because when you sell inventory, you have to measure the cost. You have to measure the price on the basis of fixed unit of output, on the basis of per unit of output. Right. So fixed unit of your price per unit is 20 rupees on the basis of overhead. Now apply this 20 rupees. Apply this 20 rupees output. Allocation of fixed overhead. Allocation of fixed overhead. So friends, what is my total overhead? What is my total fixed overhead? My fixed overhead per month. Let me write here. Fixed overhead. My fixed overhead per month is 1 lakh. Fixed per month it is 1 lakh. 5,000 multiplied by 20 and my per unit comes out 1 lakh. Is there any difference? Answer is no. Is there any difference? 1 lakh minus 1? No. Number 2, in this case, in case number 1, my actual output is equal to my normal output, right? Here, production is equal to normal or budgeted production, normal production. If I'll apply this 20 rupees here, 8,000 multiplied by 20, it is 1 lakh 60,000. Is there a difference? Yes. Can you do this? Can you apply 20 rupees when their actual production is more than your normal production? Can you apply 20 rupees on per unit of output? वो तो नहीं कर सकते ना, क्योंकि आपकी फिक्स कॉस्ट तो 1 लाख रुपए, योर फिक्स कॉस्ट इज 1 lakh rupees ओनली, बट you have a larger number of output, you have a efficiency, आपका प्रोडक्शन में एफिशिएंसी है, और नॉर्मली आपने प्रिडिक्ट किया था कि 5,000 यूनिट प्रोडक्शन होगा, बट द यूनिट प्रोड्यूस्ड इज 8,000 विच इज बियॉन्ड नॉर्मल प्रोडक्शन. So in case your actual production is greater than normal production, in that case, you have to restrict your allocation. You have to restrict your allocation to the extent of fixed overhead only. It means in this case, your per unit of cost will go down. Your per unit cost will go down, right? When your production is greater than normal production. In that case, calculate cost per unit on the basis of on the basis of actual production. In this case, so 1 lakh divided by 8,000 comes out how much? 1 lakh divided by 8 comes out how much? It comes out 12 rupees 50 paisa. This has to be multiplied by 12 rupees 50. That clear? Is that clear, friends? Is it clear or not clear? Is that clear or not clear? Vimal, this 3000 will not go to P&L. This 3000 will not go to P&L, right? This will not go to P&L. This will go to your fixed cost only. This will go to your fixed cost only, right? I hope my voice is clear now. Right. First case number one was production is equal to normal production. Case two was production is greater than normal production. Case number three, 1000, right? Or if I have to summarize, this is your normal case. This is your normal. This is your extra efficient. This is your efficiency. And here, your production is only 1000. It means there are some inefficiency. There are some inefficiency, right? There are some inefficiency. The actual production is less than the actual production is less than the normal production. Actual production is less than the normal production. What will happen in this case? Friends, in case of inefficiency, standard says that you have you have to charge the fixed cost only only on the basis of normal production of output. It means what is the per unit of your per unit of output is what is the per unit of cost? Per unit of fixed cost is 20 rupees and your output is 1000. 1000 multiplied by 20. 1000 multiplied by 20. Is there any difference? Yes. There is an inefficiency of 80,000. You can see that. Fixed overhead is 1 lakh, but cost allocated is 20,000 only. The cost allocated is 20,000 only. So where the another 80,000 will go? Where another 80,000 will go? The 80,000 will go to the P&L. 80,000 will go to the P&L. When production is less than production, in that case, cost needs to be allocated on the basis of fixed, on the basis of fixed, on the base, cost needs to be allocated on the basis of normal production. Normal production. So friends, if your actual production is a normal production is equal to normal production, in that case, life is very simple. Your fixed per unit of cost, your per unit fixed cost is on the basis of normal production, which is same. If your actual production is less than your normal production, it means there is an inefficiency. The company is not able to produce for which it is expected to. In that case, the per unit cost needs to be calculated on the basis of normal production. तो नॉर्मल प्रोडक्शन के हिसाब से 20 रुपीज पर यूनिट कॉस्ट है, पर हमने प्रोड्यूस तो 1000 यूनिट किया, तो 20 मल्टीप्लाई बाय 1000 कम्स आउट एट 20,000. So the next 80,000 will go to the P&L. Why? Because there is an abnormal loss, there is inefficiency, so it has to go to the P&L, right? But when there is an extra efficiency, when your actual production is more than your normal production, in that case, when your actual production is more than your normal production, in that case, of course, your fixed cost will not go beyond your actual fixed cost, right? Fixed cost to 1 lakh rupees. In that case, you have to allocate less per unit, okay? So that your total cost remains same as a fixed cost. Right? Is that clear, friends? Is it clear? Let's discuss this with the institute example from institute study material. So we discussed this part. The allocation of fixed production or overhead is based on the normal capacity of production facilities. Any inefficiencies should be recognized in P&L, classified as other expense, or if an entity classifies based on function, allocated to the appropriate function. Let's discuss this example. Pluto Limited has a plant with the normal capacity to produce 5 lakh unit of product per annum and expected fixed overhead is 15 lakh rupees. So fixed overhead on the basis of normal capacity is 3 rupees per unit, which is 15 lakh divided by 5 lakh. 3 rupees per unit. Actual production is 5 lakh units. Here your actual production is equal to normal production. Okay, normal capacity. So in this case, fixed overhead on the basis of normal capacity and actual overhead will lead to the same figure of 15 lakh. Therefore, it is advisable to include this on the basis of normal capacity. Right? 5 लाख का budgeted capacity था, 5 लाख का actual production हुआ, तो 3 rupees per unit will be allocated to the cost of production. Right? Case 2. Actual production is 3,75,000, which is less than the normal production. Normal production 5 lakh है, but actual में 375 हुआ. Fixed overhead is not going to change with the change in output, right? Because it is fixed. Doesn't matter whether you will produce, not produce, fixed cost remain fixed and will remain constant at rupees 15 lakh. Therefore, overheads on actual basis is 4 rupees per unit, 15 lakh divided by 3,75,000. Hence, by valuing at rupees 4 for fixed overhead purpose, it will be overvalued and the losses of 375 will also be included in the closing inventory. You understand? मैंने क्या बताया था? I have told you that when the actual production is less than the normal production, then there is an inefficiency. And the cost of inefficiency has to go to the P&L. You remember, in our Excel example, the normal production was 5,000 unit, the actual was 1,000 unit. So what we did? We have absorbed the fixed overhead only on the basis of normal production, that is 20 rupees per unit. And the remaining 80,000 we took it to the P&L. Same way it says that, therefore it is advisable to include fixed overhead per unit on the basis of normal capacity to actual production. And they have multiplied this 3,75,000 by 3 rupees, which is 11,25,000. And balance 3,75,000 shall transfer to the profit and loss. Right? This is what we discussed, right? Clear, friends? So we discussed actual production is equal to normal production. Actual production is less than normal production. Now we are discussing actual production is more than normal production. Actual production is 7,50,000 units. But fixed overhead is not going to change with the change in output. And it will remain constant. It will remain constant at 15 lakh rupees. Therefore, overheads on actual basis is rupees 2, right? So if the production is much more than the actual normal production, in that case, your fixed cost per unit of output will go down, right? But in case of less production, it will not go up, right? Hence, by valuing inventory at rupees 3 each for fixed overhead purpose, we will be adding the element of cost to inventory, which actually has not been incurred. अगर आप 3 रुपए पे इसको allocate कर दोगे तो 22,50,000 की cost आ गई. But actual cost तो 15 lakh ही है. Whereas actual fixed overhead expense is only 15 lakh. Therefore, it is advisable to include fixed overhead on actual basis, right? So when your actual production is equal to normal production, when your actual production is less than normal production, in that case, your fixed overhead allocation is on the basis of normal production. But when your actual production is more than normal production, in that case, your fixed overhead needs to be allocated on the basis of actual production. Right? Is that clear, friends? Clear in mind or clear from mind? Let me know if it is clear. Tanisha, Pooja, is it clear? I hope the voice issue has also been settled. I came more closer to the mic now. Is it clear? Sa, Pooja, Ravish, Mansa, clear in mind. Very good. So, friend, just give me a minute. Okay, let's move on. Now, exclusion on the cost of inventory. The hit cost needs to be excluded, right? Exclusion. Abnormal amount of waste material, labor, or production overhead. For example, what happened? Let's say Tata Motors. When Tata Motors is into the manufacturing of cars, so there are huge amount of labors which are involved in the plant, and the labor went to the strike. Okay, and due to the strike, the production was hampered by 3 months. So it is an abnormal amount of waste of material labor, right? So this abnormal cost should not be form part of your cost of inventory, and this abnormal cost has to be taken to the P&L. DLF or let's say MR Group or DLF, they are into the construction of the flats. While construction of the flats on the construction site, there is a robbery or there is a fraud where 1000 cement bags have been stolen. 1000 cement bags. Again, it is an abnormal cost and it has to be taken to the P&L directly. It will not form part of your cost of inventory. Your inventory per unit of output, your inventory cost should not be inflated. This has to be directly taken to the P&L. Administrative overhead. For example, the finance department salaries, audit fee, this will not be allocated to the cost of inventory. This is an administrative overhead and it has to directly go to the P&L, right? Your advertisement cost, your audit fee, your finance department salary, your corporate office expenses, this will not be allocated to your cost of inventory. This is an administrative overhead and has to be taken to the P&L directly. Storage cost, unless those costs are necessary in the production process before a further production stage, right? The company has manufactured 1000 packet of chips and they have stored in the warehouse for which they are paying a warehouse rent. This storage is not necessary. The company has done the huge production, right? And that is why they have kept it into the warehouse. Okay. They have kept it into the warehouse. Had this cost not been there, had this production not been there, this storage would not be required. I mean to say, अगर इतना excess production नहीं होता तो उसको storage भी करने की जरूरत नहीं होती. But for example, if there is a kind of a product which requires storage mandatory before a further production stage, for example, wine needs to be stored for years to get it matured, right? Okay. So, for example, ice cream, from making a ice cream from milk to ice cream, it is important to refrigerate or it is important to store in a refrigerated environment. In this case, this kind of storage cost is will form part of inventory, right? But otherwise, a normal storage cost, normal warehouse cost will be taken to the P&L. It will not form part of your inventory. Selling cost. The company is incurring, the company has engaged Mahendra Singh Dhoni to advertise its product, right? Or Amitabh Bachchan being a brand ambassador to advertise its product, right? So that the product will be sold. Okay. So just to promote the sales, they have engaged celebrities. So they are paying a huge money to the celebrities. These are the selling costs. This will not come under the cost of inventory. Right? Deepak, is that clear in mind? Tanisha, Geeta, Mufita, is that clear in mind? These are the few costs which should not be taken to the inventory. It has to be taken to the P&L. It should not form part of the cost of inventory. As per Ind AS 2, selling costs are excluded from the cost of inventories and are required to be recognized as an expense in the period in which these are incurred. Whether the distribution cost would now be included in the cost of inventory. So friends, it says that कि selling cost तो आपने हटा दिया, but whether distribution cost is included in the cost of inventory. What is distribution cost? It is again in the nature of selling cost only. Selling and distribution cost are generally used as a single term because both are related, as selling costs are incurred to effect the sales and the distribution costs are incurred by the seller to complete a sale transaction by making the goods available to the buyer from the point of sale to the point at which the buyer takes the possession. Since these costs are not related to bringing the goods to their present location and condition, be it a selling cost, be it a distribution cost, it is not a mandatory cost to bring the inventory into a location and condition, right, to ready for the sale. It is ready for sale in the factory itself, right? You are just taking it from factory to the customer place, right? So it is a selling and distribution cost. It will be taken to P&L. It is not form part of your cost of inventory. Okay, clear? Very good. Now, friends, we have reached to one of the most important concept of Ind AS 2. And normally, if a critical question or if a complex question would be asked in the examination, it will be from this part only. And what is this? This is joint product and byproduct. You understand what is meant by joint product? What is meant by byproduct? There are three products, friends. There are three products. And let me take an example in the Excel file. Please let me know if my Excel file is visible. My Excel file is visible. Visible. Ah, one is main product, joint product, byproduct. I'll give you an example. You need to tell me, is it a joint product? Is it a byproduct? Is it a main product? Right? You need to tell me. Friends, Indian Oil Corporation Limited, IOCL, let's say. It's a oil company. They are extracting the oil well. They are extracting the oil well. They are digging the oil well to get the petrol, to get the petroleum product, petrol. So what is the main product? What is the main product? They are digging they are digging the oil well. Okay, they are extracting the oil well just to get the oil, just to get the petrol, right? And while extracting the petrol, they got some another material which is diesel as well, right? They got the another material which is diesel as well, diesel. So they got the petrol, they got the diesel, okay? And friends, after getting the petrol and the diesel, they got some other material as well, right? When they are filtering, they are extracting, they got another material as well as kerosene oil, kerosene. If I talk about petrol, petrol is the costliest material. Diesel is also comparatively costlier, right? But kerosene is kind of a cheapest material. Okay. So in this case, what is my main product? What is my joint product? What is my byproduct? In this case, what is that? What is my main product? What is my joint product? And what is my byproduct? Anta, you're right. Mufita, you're right. Petrol is my main product for which I have intended to produce, right? So petrol is the main product which I have intended to. Okay. Diesel. During the extraction, during the production, I got another product which is diesel. Diesel is a joint product because the diesel has a significant value. Diesel has a significant value. Okay. But kerosene, if I am saying that kerosene is one of the cheapest product and there is no much value to the kerosene, it is considered as your byproduct. Okay. So what is a joint product? Joint product are those products which emerges into the production processes and which has a significant value, right? Byproduct are those products which does not have a significant value, right? Which does not have a significant value. In this example, kerosene can be considered as a byproduct, right? So one thing we understood, joint product has an authority like a main product, but byproduct is a residual kind of a thing. It is a residual kind of a thing, right? So friends, let me again go back to my presentation. And now if I think about a company which is when it is producing its main product, it is getting a joint product and it is getting a byproduct. So if the joint product is there and it has a value, significant value, it means the cost of joint product has to be measured separately. Is that right? भाई अगर मैंने पेट्रोल का प्रोडक्शन किया तो मुझे पेट्रोल की कॉस्ट ऑफ प्रोडक्शन निकालनी पड़ेगी बिकॉज व्हेन आई विल सेल द पेट्रोल if I will be aware what is my cost, then only I will be able to determine the sale price, right? Likewise, in the case of diesel, if I will be aware about the cost of the diesel, then I will only be able to sell the diesel. I am just taking an example. अगर आपको कॉस्ट प्राइस पता होगा तभी तो आप सेल प्राइस डिटरमिन करोगे, तभी तो प्रॉफिट डिटरमिन करोगे ना, right? So it means in case of a joint product, in case of a joint product, it is important to identify, your cost of the joint products. But what is byproduct? If byproduct is insignificant, right, in that case, you got a byproduct and whatever net realizable value of the byproduct is there, you will net it off from your cost of the production. Your cost of production will go down, right? You're not required to measure the cost of byproduct separately, right? At what value the byproduct is there, the value which you will fetch from the sale of the byproduct, that will be reduced from the cost of the production because this byproduct is not significant. Sir, what happens if this kerosene has also significant value? In that case, it will be considered as a joint product only, right? In that case, it will be considered as a joint product only. Okay, sir. Sir, we understood the meaning of main product, joint product, and byproduct. We understood that we need to determine the cost separately for main product and joint product. And wherever the byproduct is not significant, we need to estimate the net realizable value of the byproduct, and we need to reduce from the cost of the production, right? But now the question came, how to allocate? Because when you are digging a oil well, you are getting two product out of a single production processes. So it may be a situation you will not able to identify the cost separately. So the question arises, how to allocate the common cost into the two different joint products. Is that clear? Friends, is it clear? What is the problem statement? What we are going to discuss? I hope it is clear. Very good. Very good. Yes. So when more than one product is produced in the process, if the outcome is a joint product, if the outcome is a joint product, in that case, you need to see two things. When the cost of conversion is separately identifiable, life is more simplest. You know the cost for petrol, you know the cost of diesel. Life is pretty simple. You know the cost. Friends, in that case, when the cost of conversion is separately identifiable, then there is no problem. Cost of each product is based on the separate cost incurred. You know the cost of petrol, you know the cost of diesel. But when the cost of conversion is not separately identifiable, for example, the total cost is 1000 crores, right? And you got, let's say, 100 barrels of petrol and 100 barrels of diesel. And you know the cost is 1000 crores, total cost. How to allocate this total cost? So this total cost needs to be allocated on the basis of relative sales value of each product, right? Either at the stage in the production process when the product becomes separately identifiable, or at the completion of production. Friends, for example, you know that my total cost is 1000 crores, right? And I have two products. I need to sell petrol at 100 rupees and I need to sell diesel at 90 rupees. So what is the ratio of the selling price? 9:10. So I need to allocate my 1000 crore in the ratio of 9:10, right? So in that case, the cost needs to be allocated on the basis of relative sales value of each product, right? Is that clear? Sir, what happens if the outcome is main product with a byproduct with a kerosene, petrol with a kerosene? So when the byproduct is immaterial, I have told you that it is insignificant. Simple. Byproduct is measured at net realizable value, and this value is deducted from the cost of the main product. फायदा हो गया. But when the byproduct is significant, the kerosene is as good as diesel. Of course, it has to be considered as a joint product. It has to be considered as a joint product, right? That as a joint product. Is that clear? Please let me know if you have any question so far. I will discuss one case study on this aspect. It's important to understand. Please let me know if you have any question so far. Any question on this? Shall I move ahead? Okay. Let's discuss this case study on joint product and byproduct. A very good case study, very good illustration from ICAI study material. In a manufacturing process of Mars Limited, one byproduct BP, there is a one byproduct BP, emerges besides two main products. So this question is about two main product, means joint product, and one byproduct. MP1 and MP2 apart from scrap. So in this case, one byproduct is there, which is BP, and two main product is there, which is MP1 and MP2. Details of cost of production process are here under, right? Raw material, 14,500 unit. The amount is 1,50,000. Wages, 90,000. Fixed overhead, 65,000. Variable overhead, 50,000. Okay. Raw material, 1,50,000. Wages, 90,000. Fixed overhead, 65,000. Variable overhead, 50,000. MP1, the first main product, MP1, the output was 5,000 unit and the closing stock was 250 unit. MP2, the output was 4,000 unit, the closing stock is 100. BP, 2,000 units. These are the production of these main product and byproduct. Average market price of MP1 and MP2 is 60 rupees and 50 rupees per unit respectively. And the byproduct is sold at 20 rupees per unit. So selling price is available. MP1 60 rupees, MP2 50 rupees, byproduct 20 rupees. So sell price is available. And there is a profit of rupees 5,000 on sale of byproduct after incurring separate processing charges of 8,000. So there is a profit of rupees 5,000 on sale of byproduct. But this profit is after incurring separate processing charges of 8,000 and packaging charges of 2,000. Rupees 5,000 was realized from scrap. And there is a scrap also. And out of the scrap, 5,000 rupees was realized. Okay. Calculate the value of closing stock of MP1 and MP2, the value of 250 units and 100 units on 31st March 2001. This is the question. Let me know if you have been able to understand this question or even you have not been able to understand this question. There are three products, two main product, one byproduct, and there are some kachra as well. Kachra means scrap as well, right? The cost is given in this column and the total output is given in this column and the closing stock is given in this, right? Some other information is given in the question. Sale price of main product means joint product is given 60 and 50 per unit and byproduct is 20 rupees per unit. It is given. And it is also given that there is a profit of 5,000 on sale of byproduct. And it is also given that to sell the byproduct, there is a processing charge of 8,000 rupees and packaging charge of 2,000 rupees. Means the company has incurred 10,000 rupees to sell the byproduct, but it has earned 5,000 rupees as well. And the 5,000 was realized from the sale of the scrap, right? You need to calculate the closing stock of MP1 and MP2 as on 31st March 2001. I hope the question is clear to all of you. Very good. Let's go to the solution. First of all, you remember we need to compute the selling price of the byproduct. I mean to say NRV of the byproduct, net realizable value of the byproduct, right? Because that net realizable value has to be deducted from the cost of the production. This byproduct is sold at 20 rupees per unit and the 2,000 units are there. Selling price. My selling price is 2,000 unit multiplied by 20 rupees per unit, 40,000. I am able to sold this byproduct at 40,000 rupees. But for selling this byproduct, I had to incur a separate cost of 8,000 rupees on processing and 2,000 on packaging. So what is my net realizable value? My net realizable value is 30,000. What is your net realizable value? Selling price, estimated selling price minus estimated selling cost minus estimated cost of conversion. So my NRV is 30,000 rupees. I got a benefit of 30,000 rupees out of processing my main product and joint product. So friends, now this 30,000 has to be reduced from the cost of production. What is my cost of production? I have a raw material, I have a wages, I have a fixed overhead, I have a variable overhead. This is given in the question, right? Right. And this NRV of 30,000 needs to be deducted. And there is a sales value of scrap as well of 5,000. There is a sales value of scrap of 5,000 as well, right? So this 35,000 needs to be deducted, and the total net cost is 3,20,000, which has to be allocated between the joint product MP1 and MP2. Let me know if you all are comfortable with this solution so far. Let me know if you all are comfortable. If you have any doubt, even a small doubt, I am ready to answer. I am happy to, repeat it again. So what I have done, simple. I have calculated the estimated selling price of byproduct, and I got 30,000 rupees. The scrap sale is also given, which is 5,000 rupees, right? And what I have done, I have deducted this 30,000 and 5,000 from the total cost of the production. I got a net cost of production, which is 3,20,000. Now the main work comes. Now I need to allocate this 3,20,000 into the relative sale price of joint product, right? Okay. Output. What is my output? My output of MP1 is 5,000. MP2 is 4,000. My sale price of MP1 is 60 rupees and MP2 is 50 rupees. What is my total sales value? 5,000 multiplied by 63 lakh and 2 lakh. What is my ratio of allocation? What is my ratio of allocation? 3:2 is my ratio of allocation. So I need to allocate 3,20,000 into 3:2. So 1,92,000 needs to be allocated to MP1. 1,22,800 needs to be allocated to the MP2. What is my cost per unit? 1,92,000 divided by 5,000. 1,28,000 divided by 4,000. 38 rupees 4 paisa, 40 paisa, and 32 rupees. Do let me know if you have any problem, challenge in understanding this calculation, that how have I allocated. Yeah, please let me know if you have any problem. Please let me know, friends. No any challenge? Simple. What I have done, I have calculated output multiplied by sales price per unit. I got the sales value. Then I have allocated the total cost, net cost of production into the ratio of the sales value, right? Simple. And then whatever cost I got, 192 and 128, I divided by the output produced, and it has given me the cost per unit. Now, what was the ask of the question? Determine the closing stock value of MP1 and MP2. My closing stock was 250 unit and 100 unit. My cost is 38.4 and 32. And this is my value of the closing stock, 9,600 and 3,200. Right? Mansa, first of all, 4 things are here. Number 1, joint product 1, which is MP1, joint product 2, which is MP2, byproduct, which is BP, and scrap. Scrap is also there, right? Scrap is also there. So scrap is not an inventory. Scrap has to go at the sales value. Okay? Net realizable value has to be calculated for this byproduct, right? Coming to the difference between sale and net realizable value, which I am going to discuss in the later part of this session. Net realizable value is equal to sales price minus estimated cost of completion and estimated selling cost, right? So NRV, for calculating the NRV, you have to reduce your selling cost and cost of conversion from the selling price, from the sale. So these are two different aspects. Byproduct is different and scrap is different, right? It's 8:30 now, friends. So let's have a break for 5 minutes. We will start at 8:35. Okay, we'll start at 8:35. So we have covered this concept of main product, joint product, byproduct in detail with the help of this illustration as well. Now let's come to the cost formula, right? So we understood the cost of inventory. We understood this, how to allocate the cost of, fixed overheads. We understood that, the concept of allocation of cost into the joint product, into the byproduct. So now we need to understand that how to determine the valuation of the closing stock, right? When I say valuation of the closing stock, it means that, during the year, you are doing a lot of purchases. For example, you are a trading organization and you are doing a lot of purchases during the year and you are purchasing, you are selling. At the end, you got some closing stock, right? You got some closing stock. To give you more clarity, for example, you are a trader of a motorcycle, right? You have a showroom and you have a motorbikes, scooty. So you purchased 50 unit of scooty in in the month of January. Okay. Or let's say in the month of April. Then you again bought 100 unit of scooty in the month of July. Then you got again 50 scooties in the month of October. Then you again bought 100 scooty in the month of January. So in total year, you bought 50 plus 100 plus 50 plus 100, 300 scooties. And you sold 30 scooty in the month of May. You sold around 40 scooty in the month of August. You sold 50 scooty in the month of November. And you sold 50 scooty in the month of February. So 30 in May, 40 in August, 50 in November, and 50 in February. What is the total? 30 plus 40, 70, plus 50, 120, plus 50, 170. So you bought 300 scooties in the year. You sold 170 scooty in a year, and your closing stock is 130 scooties. Now the question comes, what is the value of this 130 scooties, right? Because you have a similar product. Okay. So what should be the value of this 130 scooty? So what should I say? This 130 scooty belongs to, can I say, this 130 scooty belongs to 100 scooties which I purchased in the month of January and 30 scooties which I purchased in the month of October? Can I say this? So friends, for that purposes, standard says that for valuation of the closing stock, number one, you need to see whether the inventory is specifically identified or there is no specific identification is there, right? Whether specific identification of inventory is there or there is no specific identification of inventory. So let me explain you what is the meaning of specific identification or what is the meaning of specific identification. Friends, if you went to the shed or I would say the stockyard of the automobile companies like Maruti, like Tata, Hyundai, Skoda, you will find hundreds of cars in the stockyard, hundred of cars in the stockyard. All white color Maruti Swift car, all white color Maruti Swift car in the stockyard, right? Whether all cars are similar or not similar, or I would say same, not similar, same. The build, the color, the shape, the features, everything is, interchangeable. Everything is interchangeable. You all agree with me? You all agree with me now? Yeah. These cars are interchangeable, right? 100 Maruti Wagon car or Maruti Swift car, there is no specific identification to those cars, right? If you will say that I have to purchase that car, so the driver will go to the stockyard and took any car and sell you, right? So there is no specific identification of those cars. But if I talk about Dilip Chhabadiya, have you heard about Dilip Chhabadiya? You heard about Dilip Chhabadiya? Yeah. So Dilip Chhabadiya is into modified cars, pretty cars, modified cars. You will take a Maruti Swift and he will modify that car like a Tarzan. Okay. You will bring another customer will bring Maruti Swift. He will modify the car like a Hulk car. Okay. So the cost of modification is much more than the value of the car even at times. Okay. Somebody has nothing. He is into the modification, modified cars, sports cars, modified cars. So friends, for example, five customer with came to Dilip Chabadiya with the same Swift car, and they said, I need this modified car in this manner. I need modified car in this manner, right? So for Dilip Chabadiya, every car is having a special identification. Every car is separately identified. Every car has a specific identification, right? This is Alok's car. This is Pooja's car. This is Tanisha car. This is Viraj's car. This is Vimal's car, right? Why? Because unlike Maruti, like Maruti has a similar cost for all the cars, for all the Maruti Swift car, right? But Mr. Dilip Chabadiya has a different cost for these different cars, right? The car is same, but the cost of modification is different as per the need and ask from the customer. So if I talk about Dilip Chabadiya, how he will value the closing stock, let's say, if he has to sell these cars after modification, how he need to value the closing stock? Of course, he need to value the closing stock on car wise, right? If he has 100 cars in his stock yard, he has 100 cars in his godown, in his showroom, in his service center, he will go by every car and he will determine the cost incurred on that car, right? And then get the valuation of the closing stock. But for Maruti, it is not specifically identified. So Maruti cannot go and cannot take the cost of each individual car. Okay. So what Maruti will do, not Maruti will not be able to identify the cost of each car separately because each car is the same car, similar. Have you understood this fact? So friends, if there is a specific identification, the life is very simple. You need to determine the cost of the of that particular item for the valuation of the closing stock. If there is no specific identification, then you need to apply either FIFO or weighted average cost formula. What is meant by FIFO? What is meant by FIFO? First in, first out. First in, first out. So let me give you an example and please confirm if my Excel file is visible to all of you. Please confirm. What is meant by FIFO? Per sold, right? Let's say in January, purchased 1,000 quantities, 1,000 quantities, price per unit, price per unit, sold quantity. 1,000 unit purchased, price per unit was 10 rupees. In February, right, is again a purchase of 500 unit, price is 50 rupees per unit, 10 rupees per unit. In March, there is a quantity sold, say 100 quantity sold, in 500 units purchased, right, at rupees per unit. In November, 100 units sold, in January, sorry, in December, again 300 units sold. So what is your closing quantity? Your total purchase quantity is how much? Purchase quantity is 2000. Sold quantity is 800. Your closing stock quantity. What is your closing stock? Closing stock quantity is equal to 100. These are no specific identification is there. There is our interchangeable product. Interchangeable product, right? These are interchangeable product. Now you tell me no specific identification is there. Then you need to apply either weighted average or you need to apply the FIFO. First in, first out. First in, first out means we will assume that whatever we have sold, it should be from the first purchases. The old stock I'll release first, and the latest stock I'll keep, right? Yes, friend, we will consider if 800 quantities are there, right? 800 quantity which is sold, it has to be from this January only. I'll consider this 800 from January only. Right? Means what is the cost of inventory which is left with me? 200 units from this, it is at 10 rupees value, and 500 units from this stock, which is at 15 rupees value. Again, this 500 stock from this portfolio of June, which is 20 rupees value, right? This will be your 1200. What is the value of the closing stock? Value of the closing stock will be how much? 19,500. 19,500. So what is my per unit value of the closing stock? The per unit value of the closing stock is 16 rupees 25. Hence, is that clear? Simple, first in, first out. I am assuming my entire sales is from the first purchases, right? I will reduce my sales quantity from the earlier ones. Right? This FIFO and we did in subject of costing intermediate. You are right. So LIFO is not allowed, friends. Only FIFO and weighted average is allowed. Sir, what is weighted average method? What is weighted average method? Simple. Your weighted average. 1,000 is the total quantity you have purchased. Right. What is the value? What is the total value? What is the total value? Let's say total age price. I have purchased my 2,000 unit of output, 2,000 unit of goods at 27,500. Is my weighted average cost? My weighted average cost is 13 rupees 75. What is my closing value? Closing quantity is 1,200. My closing stock valuation, my closing stock value is equal to how much? Is equal to 1,200 multiplied by 13 rupees 75. 16,500. And in your going by the FIFO, it was 19,500. Going by the weighted average, it is 16,500. This is the difference between your FIFO method and your weighted average method. I hope this FIFO and weighted average is clear to all of you. This FIFO method and weighted average method. Is it clear to all of you or it is not clear? It is simple. What we have learned in CA intermediate, this is the same method. Clear in mind or clear from mind? Clear in mind. Very good. Friends, LIFO is prohibited. There is no LIFO, right? No LIFO. An entity shall use the same cost formula for all inventories having a similar nature and use to the entity. Same cost formula the entity is required to use. For example, the entity is into trading of three goods, like they are into cold drink, they are into grocery, let's say pulses, okay, rice and pulses, and cold drink. For cold drink, they can use the FIFO method. For rice and pulses, they can use the weighted average. So the entity has to use the same cost formula for all inventories having a similar nature and use to the entity. For different, for inventories with a different nature or use, different cost formula may be justified, right? Next, we discussed cost formula. If the inventory is having a specific identification, it is not interchangeable, like in case of modified cars, it is not interchangeable. Then you have to take the valuation of the respective inventory for arriving at the closing stock valuation. But if it is interchangeable, then either no specific identification is there, either you can go to the FIFO method or you can go for the weighted average method. LIFO is not permitted. Now we are talking about the inventory valuation techniques. Earlier we were talking about formula, now we are talking about techniques, right? So friends, we have two kind of methods. One is traditional, one is modern. I would say traditional, non-traditional. Okay. So friends, the inventory valuation technique will depend upon your kind of inventory, whether it is ordinarily interchangeable or it is not ordinarily interchangeable. For example, Maggie, you will go to the you will go to Big Bazaar, you will go to the Reliance Fresh, and you will pick one Maggie out of the basket. Pick one Maggie. It is interchangeable. You will go and buy one cold drink. It is interchangeable, right? Jewelry, whether jewelry is interchangeable. Can you say that? No. Instead of this, I'll buy this jewelry. Every jewelry has a different value. Jewelry is not interchangeable. Modified cars, it is not interchangeable, right? Aircraft, it is not interchangeable. And if the inventory is ordinarily interchangeable, then the historical cost method, simple, FIFO, weighted average, historical cost, traditional method. Inventory is ordinarily interchangeable means no specific identifications. But what is the modern method? What is the non-historical method? The non-historical method is if the inventory is ordinarily interchangeable, no specific identification is there, then either you can go with the retail sale price method or you can go with the standard cost method. What is meant by retail sale price method? It is applicable for the departmental store. Like you must have seen the departmental store, they have a huge amount of small grocery item, rice, pulses, bread, butter, right, spices, right? So cold drink, lot of items are there, chips, biscuits, chocolates, and they are of different types and they are into bulk. Okay. So normally, how do these FMCG companies with like departmental store, how do they keep their inventory valued? How do they value their closing stock, value their inventory, right? Because again, it is very difficult to calculate by FIFO method or by weighted average, let's say. So normally what they do, they apply the retail sale price method. They apply the retail sale price method. For example, you know, first of all, it is used when large number of rapidly changing items with similar margins are involved. For example, these departmental store have a policy that they have to have a margin of 10% on every product, right? 10% margin on every product. So how they will value their closing stock? Simple. They will value their sales value, right? That what is my sales value? Okay. For example, the total sales value is 500 rupees. So they will reduce the margin from the sales value to arrive at the cost. So this is retail sale price method. means at the value at which you are selling the goods minus your margin is equal to your cost of inventory. Or what is standard cost method? So standard cost method means normally this talks about what is my normal cost of production, right? For example, let's say if I talk about Maruti. So Maruti is manufacturing thousands of cars, and then they know that whatever cars I have manufactured in this particular season or in this particular period, what happens in this particular period, what happens, I know that if I am manufacturing a Maruti Swift VXI model, it will cost me 10 lakh rupees. It will cost me 10 lakh rupees according to the material, labor, overheads, right? It will cost me 10 lakh rupees. If I have 5 cars in my godown, so what is my closing stock? 5 multiplied by 10 lakh. So this standard cost is applicable more from the perspective of where the company is a manufacturing company, right? And when they are manufacturing, they are producing. So more from that perspective, standard cost method is up, right? Retail sale price method is applicable when the company is into, a small kind of large number of items like departmental store. I hope this inventory valuation technique is clear to all of you. When there is no specific identification, we have two methods, two technique for inventory valuation. Number one is historical technique, which is FIFO and weighted average. Number two is a modern technique, which is a non-historical method, which is retail sale price method or standard cost method. I hope this first part is clear. Friends, is that clear or not clear? If it is not clear, I will again try to get it clear or try to, again repeat the explanation. And I am explaining you with the help of layman examples, cars, Maruti, manufacturing, right? So that you will be able to connect these things. Now the second, when inventory is not ordinarily interchangeable. Dilip Chhabadiya modified cars. Jewelry, for example, jewelry. If I talk about jewelry, of course, it is not ordinarily interchangeable, right? It is not ordinarily interchangeable. Jewelry. So in case of jewelry, the specific identification method is there. In case of modified cars, the specific identification method is there. Generally used in jewelry and tailor-made industry. Tailor-made means where the customized products are sold as per the desire of the customer, right? In that case, you need to go by item and you get the actual value, and then that will be the value of your closing stock, your value of stock, right? Very good. I got 9 responses, and everyone is saying that everything is clear so far. Very good. Let's discuss cost technique with the help of this ICAI study material. Example: Mars Fashion is a new luxury retail company located in Lajpat Nagar, New Delhi. Kindly advise the accountant of the company on the necessary accounting treatment for the following items. One of the company's product line is beauty product, particularly cosmetics such as lipstick, moisturizer, and compact makeup kits. The company sells hundreds of different brands of these products. Each product is quite similar. It's purchased at similar prices and has a short life cycle before a new similar product is introduced. The point of sale and inventory system is not yet fully functioning in this department. The sales manager of the cosmetic department is not sure of the cost of each product, but is confident of the selling price. कॉस्ट का नहीं पता उसको कि हर आइटम की छोटी छोटी आइटम की कॉस्ट क्या है, but he is confident of the selling price because this is what he has to sell, right? And has reliably informed you that the company on an average make a gross margin of 65% on each line. So he know the sale price, he know the margin, but he is not sure about the cost of each item because there is a large number of small items. So which method is suitable in this case for valuation of stock, valuation of inventory? Please tell me. Mars Fashion also sells handbags out of the beauty product. In addition to beauty product, it also sells handbags. The company manufacture their own handbags as they wish to be assured of the quality and craftsmanship which goes into each handbag. The handbags are manufactured in India in the head office factory, which has made handbags for the last 50 years, right? Which has made handbags for the last 50 years. Normally, and this company is into manufacturing, right? Mars manufacture 1 lakh handbags a year in their handbag division, which uses 15% of the space and overheads of the head office factory. The division employs 10 people and is seen as being an efficient division within the overall company. So this division is sure about the cost which is incurred. This division is sure about what is my standard cost as per the normal capacity, as per the normal production capacity, right? So according to this situation, which could be the best method for valuation of the stock? This is saying retail sale price method. The first one is retail sale price method, RSL. And the second one is, yes, standard cost. Very good. The second one is standard cost. Right? One is standard cost. First one is retail sale price. You can see the answer. The retail method can be used for measuring the inventory of beauty products. The cost of the inventory is determined by taking the sale price of the cosmetic and reducing it by the gross margin of 65% to arrive at the cost. The handbags can be measured using standard costs, especially if the result approximate cost. Given that the company has the information reliably on hand in relation to direct material, labor, expenses, and overheads, it would be the best method to use to arrive at the cost of inventories. Right? Let's discuss about the FIFO method, right? And weighted average also. Let's quickly do this case study. Mercury Limited uses a periodic inventory system. The first one was about the non-historical cost technique. This is historical cost technique. And both are relating to non-specific identification. The following information relates to 2001 to date. April, the inventory was 200 unit, cost was 10 rupees, total cost was 2000. In May, September and February, the purchases are there, which is 50, 400 and 350. These are the cost per unit. These are the total cost. And this is the total inventory unit is 1000 unit. The total cost is 12,250. Physical inventory is lying at 400 units. Only 400 unit is there out of 1000 unit. It means 600 unit has been sold out. 600 unit have been sold out. So friends, in this case, going by the FIFO method, it means this 200 unit has been sold. This 50 has been sold, 250, and 150 has been utilized from this purchases. It means the 600, sorry. So 400 is closing stock. It means 600 units have been sold. So 250 is out of this and 350 is out of this purchases. It means the 400 belongs to the last purchase of 350 and 50 out of this purchases. So 50 multiplied by 12 and 350 multiplied by 14 is your closing stock as per the FIFO method, right? As per the FIFO method. For the FIFO, your 350 out of last purchase and the second last 50. So 5,500 is the cost of 400 unit, which is your 5,500 is the cost of your closing stock of 400 unit, right? Your total cost was 12,250. 5,500 is closing stock. Your cost of sales is 6,750. Weighted average, very simple. Your total cost is 12,250. Total unit is 1,000. 12 rupees 25 paisa is the per unit cost. Closing stock is 400 multiplied by 12.25. 4,900 is your closing value. Your total cost is 12,250. Your 4,900 is closing value. 7,350 is your closing stock, right? Sorry, cost of sales, not closing stock, cost of sales. 4,900 is closing stock, 7,350 is cost of sales. Any question on this? Any doubt? Any question on this? Any doubt on this? Clear in mind or clear from mind? क्लियर इन माइंड है या माइंड से क्लियर है? माइंड में क्लियर है या माइंड से क्लियर है? इज दैट क्लियर इन माइंड गाइस? Okay, very good. Now we have reached to the last step of net realizable value. You remember the first principle, inventory has to be measured at cost or NRV, whichever is lower. What is meant by NRV? Friends, first of all, please write down NRV, net realizable value, is not a market value. It is not a fair value. Net realizable value is the estimated selling price in the ordinary course of business. Estimated selling price minus estimated cost of completion minus estimated cost of sale. Selling cost, estimated cost of completion. If you reduce these two costs, you will get a net realizable value. And this net realizable value is an entity specific value, right? And I'll give you one example so that you will always able to remember this. There is a big CA firm, which is 50-year-old CA firm, and which has become a brand name. Right? You go to the CA firm, that big CA firm, to file your return of income. And when you tell them that I need to file my income tax return, how much you will charge? They will tell you, we will charge 25,000 rupees. You will go to a small CA firm and you want to get your income tax return filed. And when you will ask how much you will charge for this income tax return, for the same income tax return, they will ask 5,000 rupees. So friends, for the same income tax return of the same assessee, which has to be filed in the same form and which has to be filed with the same department, one is asking 25,000 rupees, the second one is asking 5,000 rupees. What is this? This is net realizable value. This is entity specific value. Being that in that entity as a big brand entity, they are asking, they are able to fetch good money from the customer. The small entity would not be able to fetch good money from the customer, right? So this net realizable value is the entity specific value. Market value is the fair value, is the market driven value, right? For example, tomorrow ICAI will say that you have to charge 5,000 rupees or 10,000 rupees for such a return of income. It is a fair value, right? But the big four, due to their documentation, or the big CA firm, they may ask for 15,000 rupees, right? So NRV is the entity specific value, fair value or market value is a market driven value. And that is why it says that NRV is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost of sale. The cost of sale includes directly attributable marketing and distribution cost. Directly attributable marketing and distribution, right? Friends, your fixed goods, finished goods, and your work in progress. Your finished goods and work in progress has to be measured at cost or NRV, whichever is lower. Please write down. Finished goods and work in progress has to be measured at cost or NRV, whichever is lower. But raw material has to be measured at cost, right? Raw material has to be measured at cost. Your finished goods and work in progress has to be measured at cost or NRV, whichever is lower. Raw material has to be measured at cost, subject to some condition. Friends, raw material, which is part of the finished goods, right? For example, the company is using the semiconductor in the cars. The company is using the semiconductor in the cars. This semiconductor is a raw material for the automobile companies, right? So if the finished goods are sold at cost or above cost, right? The total cost of the car is 10 lakh rupees, right? The total cost of the car is 10 lakh rupees, and it is getting sold at either 10 lakh rupees or more than 10 lakh rupees. In that case, if the finished goods is sold at cost or above cost, in that case, raw material is always measured at cost. But if the finished goods are sold at net realizable value, means you remember cost or NRV, whichever is lower. If the finished goods are sold at NRV, which is less than the cost, in that case, the raw material is measured at replacement cost, which is measured at NRV. The raw material is also measured at net realizable value. Sir, what does it mean? I'll take an example. Friends, the cost of this mobile phone is, let's say, 10,000 rupees. And the raw material which is used in this mobile phone is 8,000 rupees, right? The raw material which is getting used in this mobile phone is 8,000. Okay. So this mobile phone is getting sold at more than 10,000 or at 10,000. The raw material will continue to be valued at 8,000. Tomorrow, what happens? Due to the change in technology, the value of the mobile phone goes down, and the value of this mobile phone becomes 7,000 rupees. Becomes 7,000 rupees. So don't you think that the value of this raw material will also go down? There will be the impairment in the value of the raw material. If the value of the finished goods is 7,000 rupees, why will I purchase this raw material at 8,000 rupees? Why will the industry purchase this raw material at 8,000 rupees? Of course, the demand of that raw material goes down, the value of the raw material goes down. So in that case, if the finished good is getting sold at NRV, means less than the cost, the raw material is also required to be measured at NRV or at replacement cost. Is that clear? Is that clear, friend? Pooja, is it clear or not clear? Work in progress has to be measured at cost or NRV, whichever is lower. Raw material has to be measured at cost. If the finished goods is measured at cost or above cost, it is measured at cost. If finished good is sold at or above cost. If finished good is sold below cost, then raw material is also required to be recognized at NRV. Right? कैसे पता लगेगा? How will we be able to know मेरा नीचे लेस पे बिक रहा है? When you go to the company's audit, when you look at the policy, when you look at the numbers, you will find that your NRV is lower than the cost, and that is why the company has recognized the finished goods at NRV. In that case, you will ask company to recognize your raw material, which is lying in your godown. That raw material is also required to be recognized at NRV. Write down of inventories and reversal of write down. Impairment of inventory. Friends, as I told you, that the finished goods and work in progress has to be measured at cost or NRV, whichever is down. Due to the low demand, for example, the NRV has gone down from 100 rupees, it become 80 rupees. So you have to book an impairment loss of 20 rupees. You have to book an impairment loss of 20 rupees. But tomorrow, when the demand will build up, demand will go up. In that case, let's say it become 95. In that case, you have to reverse the impairment loss which you have booked earlier. You have to reverse the impairment loss of 15 rupees. Right? Sir, what happens if instead of 100, it become 110? So you have to reverse the impairment loss only to the extent you have booked. You have booked an impairment loss of 20 rupees, right? Only to that extent you will reverse the impairment, right? It is an impairment loss reversal. Clear, friends? Your cost or NRV, whichever is lower, it is a conservative approach. Your NRV is 110, your cost is 100. What is lower? Cost is lower. You have to measure inventory at cost. If your cost is 100, NRV is 90. NRV is lower. You have to measure inventory at NRV, and you have to book an impairment of 10. Yes, you are right. Same concept in AS2 as well. Isha, do you have any doubt? Do you have any doubt? Rahul is asking, sir, If we have booked impairment loss in first year, can we reverse this impairment loss in the next year? For example, he is saying, sir, when I have closed the books on 31st March 22, I have written down my inventory to NRV and I booked an impairment loss of 100 rupees. And in the next year, still this inventory is there. And in the next year, the value has gone up. Can I reverse this impairment loss in the next year? Yes, you can reverse. You can reverse, right? Very good question, Rahul. Let's understand this with the help of this illustration as well. UA Limited purchased raw material at the rate of 400 rupees per kg. Company does not sell raw material but uses this raw material into the production of a finished goods. The finished goods in which raw material is used are expected to be sold at below cost. See, the finished goods in which this raw material is getting used, the finished goods is expected to be sold below cost. It means there is an impairment in the value of the finished goods. At the end of the accounting year, company is having 10,000 kgs of raw material in inventory, which is lying in the godown. As the company never sells the raw material, it does not know the selling price of the raw material and hence cannot calculate the realizable value of the raw material for valuation of inventory. Since the company is not selling, so how will the company be able to know the NRV? NRV is net realizable value. It is entity specific value. You remember I have told you, in this case, this raw material will not be recognized at cost. This raw material is to be valued at NRV or replacement cost. However, replacement cost of raw material is 300 rupees per kg. If today the company go and buy this material or the substitute material, what is the cost? It is 300 rupees per kg. So this 10,000 multiplied by 300 is your value of the raw material, right? And 100 rupees per kg impairment is going to be charged on the value of this raw material, right? Which can be reversed in future if the value go up, right? Very good. Okay. So this is what which is given as a solution. Whatever I've told you, that is written in the solution, right? Now coming to the disclosures. So you are not required to remember the disclosure. You are not required to refer the disclosure, I would say, right? So coming to the disclosure, the company has to disclose the accounting policy. The company has to disclose the carrying value. The company has to disclose the, the NR, if the inventory has been recognized at NRV, what is the impairment loss which is going to be recognized, which has been recognized? What is the reversal of impairment loss? If the company has placed the inventory, so that is required to be disclosed. So these are the disclosure requirement in India. And this is your favorite slide. Thank you so much, friends. I have covered since beginning. I have told you that inventories are assets which are held for sale in the ordinary course of business, which are in the production process, or which are raw material, which has to be used in the production, right? Then I told you that inventory has to be measured at cost or NRV, whichever is lower. I have told you that inventory includes your cost of primary packing material, but not the secondary packing material. Then we discussed cost includes purchase price plus cost of conversion plus your directly attributable cost. Then we discussed in cost of conversion, there could be some direct cost like labor, material, overhead. There could be some indirect cost like depreciation of machinery, rent of factory, right? So there could be a variable production overheads and the fixed production overheads. The variable production cost is per unit fixed, but the fixed production cost is the totality fixed. It is fixed in totality. So the fixed production needs to be allocated to the output produced on the basis of normal production. If your actual production is equal to normal production, your allocation has to be on the basis of normal production. If your actual production is less than the normal production, your allocation is on the basis of the normal production. And if there is any inefficiency, it has to go to the P&L. If your actual production is more than the normal production, in that case, your per unit fixed cost will go down and it has to be on the basis of actual production, right? Then we talked about in case of a inventory manufacturing or a process, if there are joint product and byproduct, so normally the byproduct is insignificant in value. If byproduct has a significant value, it is as good as joint product. So if the separate cost is identifiable, then there is no problem. But if the cost is not identifiable, then the total cost needs to be allocated on the basis of on the joint product on the basis of the relative sales value. If there is any realizability from the byproduct, that net realizable value has to be reduced from the cost of the production. And after that, it has to be allocated into the joint product. Then we discussed the cost formula. In case of a cost formula, you need to see whether the specific identification is there. I mean to say, it is not ordinarily interchangeable. Inventory is not ordinarily interchangeable. Then you have to measure the cost of the respective item to value that inventory. But in case of where no specific identification is there, it is ordinarily interchangeable, then there are historical method, non-historical method. Historical method is FIFO, first in, first out, and weighted average. LIFO is not permitted. Non-historical method is retail sale price method, like departmental store, where you need to estimate your sale price minus margin is equal to cost. Your standard cost, what is my standard cost per output? When number of unit of output multiplied by standard cost will give you the cost, right? So this is what we have discussed in terms of cost technique. Then we discussed NRV. Net realizable value is nothing. It's a entity specific price, which is estimated selling price minus cost of production minus cost of sale, right? And inventory has to be measured at cost or NRV, whichever is lower. If NRV is lower, it has to be at NRV, and impairment is required to be booked. Okay. Finished goods and work in progress will always be measured at cost or NRV, whichever is lower. Raw material has to be measured at replacement cost or NRV only if the finished goods is selling less than cost, right? So this is what we have discussed in this particular standard. I have covered 5-6 questions from ICAI study material in addition to my lemon examples, which I have covered in this class to make you guys more comfortable and understand this Ind AS too. So if you have any question, so I will wait for the next 30 seconds and I will be happy to respond. I will be happy to solve. If there is no any question, then I will be happy to conclude this session. Wonderful feedback, and I am glad that you are able to understand the concept in the example. If you have any question, please let me know. I have also recapped this entire standard. And thank you so much, friend. If you don't have any question, I would be happy to conclude the session. Thank you so much. Stay safe, stay happy.